Four out of five buyers right now are sitting on the sidelines waiting for interest rates to drop. But what if I told you that waiting could cost you more money than buying today? Let's talk about the math. Most people aren't running. So, I would like to introduce you guys to Daniel Bellomy, one of my preferred lenders. What I'd like to share with all of the viewers today, and please add anything else that you'd like. I got to work with Daniel on some transactions before, and I can tell you firsthand, he is one of those lenders who actually picks up the phone, explains things in a way that makes sense, and is very willing to think outside the box to make deals work. My buyers have given him rave reviews, and honestly, that's why I really wanted to have this conversation with him today. Daniel, thank you so much for being here.
Oh, thank you for having me.
So, did I miss anything?
So, I've been in the mortgage industry for 11 years now, and I've held a number of different positions and roles within the industry, from all the way being on the very back end of the deal after everything's closed and everybody's in their house and everybody's happy. So, post-closing, funding and shipping, delivering loans to investors, all the way to the very beginning of the transactional process, such as lead generation through call centers, things like that. I have been a licensed loan officer, branch manager, and now national sales manager for the last 6.5 years. About have gotten to see the mortgage process from beginning to end and can understand every step of the process. So that way I can ultimately help educate clients, agents, anybody involved, what those processes and steps look like on each and every single transaction.
I love that. And I love how when I talk real estate, you totally get it. Sometimes you're like, well, have you thought about this? And I'm like, oh,
If you do it long enough, you can start to pick up little tips and tricks along the way.
which clearly you have. It's always a pleasure working with you and sending buyers your way.
I love to help them out.
Let's get started on this one about hearing everyone saying, well, I'm just going to wait until the rates drop. Why is that advice not as safe as people think?
The big reason why waiting for the rates to drop might not have the best outcome when it comes to financial health growth, and especially when dealing with real estate mortgages, is as rates drop, demand is going to increase. And so when that demand increases, I don't want to sound cliche, but it's simple economics, it's supply and demand. So if there's less supply because there's a lot more demand and that supersedes it, you're going to start to see prices come up. And so when you see those prices come up, the actual realized savings in interest payments, just because the rates have come down, start to go out the window to a point where it might actually start costing you money to wait for those rates to come down before even acquiring a property. Due to the economic policies going on with COVID and everything else, housing prices skyrocketed and then they stayed high. And I would say they've started to come back down a little bit just by nature of being probably a little bit overinflated, unfortunately.
It's interesting how they rise so significantly. And for many homeowners, especially, I will say it definitely is giving current buyers negotiating room.
100%. I'm seeing a lot of folks during those low interest rate timeframes. People were coming in and you'd see houses getting sold or under contract for 15, 20, 30,000. There's a house I had that went under contract for $100,000 over asking because it got into a
Wow.
bidding war.
Wow.
And when you have that amount of demand, the actual cost felt by yourself, the consumer, is substantially higher than coming in and taking advantage of, hey, in today's current market, the ability to come in and either negotiate on sales price or come in and negotiate with seller credits, closing costs, things like that to offset some of that upfront expense. And not only that, but being creative and kind of working with not only you, the agent, but myself and coming up with a plan of, hey, how are we going to maximize the benefit that we can get out of a deal for a client? Let's say we come in at asking price and so we want a $10,000 credit to the seller. That's the same number at the end of the day, but to us, you as a buyer, that's going to have two very different impacts on your out-of-pocket costs as well as your monthly payment costs. And one of those is going to have a bigger impact on your day-to-day finances. And so that's where having a really good team
Yeah.
of a real estate agent and loan officer helps the home buying and process become infinitely easier.
I love that you said that. I'm like, hey, Daniel, how can I best negotiate this deal? Depending on whatever my buyer might need. As a realtor, I don't need to know all their financial data, but I can call you up and say, well, what's going to be best for them? I love that
Yeah,
you.
using it as an opportunity to really also help educate the client and see how each scenario might have an impact on their finances, short term and long term. Because that's the one big thing that a lot of people seem to forget is, hey, this is a house and the loans are usually for 30 years. There's a long-term aspect here that we want to take into consideration as well.
Daniel, can you walk me through maybe a real world example of what it looks like if a buyer waits for rates to drop even 1%, but prices
Yeah,
go up maybe 5%? Especially in our county, 3 to 5% increase in value year over year, but we're definitely not seeing an equivalent rate drop. I'm excited to
absolutely.
see what it looks like to wait.
What I'm going to do is go ahead and show a quick scenario of what this might look like if we do a current file today and what that might look like. And then what would happen if we waited for rates to drop a whole 1%, but prices increased by 5. So I'm going to go ahead and share my screen real quick. So let's do this. We'll jump into this. Current scenario for this home, we're using a purchase price of 350,000, 5% down, 760 credit, and a 30-year fixed rate conventional loan. Pretty standard loan structure, nothing too crazy. 5% down just because that seems to be more common than having the cash for 20% down. But with today's current rates at 6.125 with a point, your payment comes out to be about $2,430. And then your cash to close before any sort of initial deposits for earnest money or seller concessions are negotiated comes out to be about $32,000. And now keep in mind that's including taxes, homeowners insurance, title, the whole nine. So what would happen if we waited for interest rates to come down a whole 1% and the purchase price to come up 5%?
Before you get too far, I'm like thinking as a buyer, oh my God, I need to have $32,000 to close.
Mm-hmm.
I just want to clarify this is
Broad generic structure. There's a lot of nuance to this, but really the key feature here that I want to show you guys and discuss is actually going to be more about the payment than anything
perfect.
else. Because the cash to close might be a down payment assistance program. That's going to drastically impact the cash to close number. So I don't want you to look at that and be like, oh my goodness, this is set in stone. This is how much I need to have. This is
Right.
where having a good team with both an agent and a loan officer really helps make this a much more streamlined and informative
Doable.
process for you.
Yeah.
So what I'm going to go ahead and do is let's say the purchase price of 350 goes up a whole 5%. That's an increase of $17,500. So your new purchase price is 367,500. We're going to keep that same 5% down. And let's say interest rates, we're now at what, 5.5% for an interest rate? Now, once you have a property here, the scenario is now you've waited it, let's say, a full 12 months. So next year. So now your purchase price is $367,500 and your interest rate comes down to 5.5. Now you will save about $32 a month in payment between those two interest rates and the difference in price. However, your upfront costs are going to go up by $1,100 or so, just in baseline costs. And then not only that, but you have now missed out on 12 months of building equity in the home, not only through regular monthly payments, but also appreciation. And if you have been renting in that meantime, you are now out 12 months of rent. So that has the potential to add up very quickly to the tune of, let's say, so let's use
Darling.
2 grand a month as just a quick cost calculator. You've got $24,000 in rent plus the $1,100 in upfront cost at closing because of the price increase. So now realized loss on those two is about $25,000 because you spent that 12 months paying rent versus building equity by paying down the balance on your loan. You've missed out on average 3 to 4% a year in appreciation, if not more, depending on what the market does,
Yep.
which if you get in before rates come down and demand goes up, then you can beat that appreciation hike. Let's say you buy it for 350, 12 months later, demand has increased substantially. That home is now worth 375. Maybe it's even surpassed that 5% mark. So there could be a very large loss, not only in upfront costs through paying rent expenses plus the increase in down payment on 367.5 versus 350, but the lost appreciation value there as well. Even though you might look at it and say, oh, well, 6.1 to 5.5%, I'm going to be saving $32 a month. Well, the break just on that upfront cost of $1,100 is 34 months. In reality, you're missing out on a substantial amount of equity and having a substantial amount of upfront increased costs through rent to save 32 bucks a month, which is going to make you $1,100 over 34 months. It's a time value of money is really what it comes down to. The sooner you're able to get into a home and start building equity, that home is more of an asset versus a liability. It's something that you can utilize and leverage later on in life as well. You can treat it almost like a bank account. You can borrow money against the value of your home, use that for consolidating high interest credit debt. You could do any number of things with it. And the sooner that you are able to get into that home and start building equity and building up that investment, the better.
I love how you illustrated that so we talked about what the cost of waiting is. Let's flip it. Just out of curiosity, are there
Yeah.
times when waiting does make sense?
Absolutely. Yes, I would say there's just as many individuals that it doesn't benefit to wait, and as there is, it does benefit to wait. And a lot of that comes down to things outside of finance more than anything. A lot of it has to do with time lane. I'm getting a new job. I'm looking to qualify. I don't have this job yet. Maybe they're going from, hey, I've been working a W-2 job for the last 5 years, but now I'm self-employed. Or, hey, I'm moving into a position where I'm 1099. There might be some limitations there where they have to wait and there's no way around it. So, for those types of situations, yes, it makes sense to wait, not only because it's going to help you establish that work history and that ability to qualify, but be able to qualify for the type of home that you want. And sometimes that takes time. Or if, let's say, you're coming off of a really rough season in life where credit hasn't been the best, it happens to the best of us. And so maybe it's an opportunity to set up or game plan around building and structuring and repairing credit. So that way, by the time that is taken care of or that's been established and gone through, you're now in a much better position to qualify, maybe not even for a higher amount or a more expensive home, but for the same level of home, but at a much more affordable rate or a much lower cost when it comes to interest rates, buy downs, and things like that. And so there's a lot of different variables outside of just the numbers that could impact somebody's ability to wait. It really comes down to each individual person, which is why we have a consultation about getting pre-qualified. It's not just a, hey, submit an application and here you go. It's, hey, submit an application. Let's go through this. Let's build a scenario and a plan around you, the buyer's personal financial goals and strategy, because what works for one individual might not work for another.
I love that. So what I'm getting from what you're saying is that I see a lot of buyers or potential buyers that are trying to figure it out on their own. Oh, well, I can't, and making assumptions. It doesn't hurt to reach out to a lender, run some numbers, just have the conversation to see where they're at. And it doesn't mean that you have to do a credit pull on them.
Correct. So generally, how I tend to run things is I'll do the least intrusive approach. We're going to start with a soft credit check, just so that way I can see exactly what's going on, credit scores, look and see what's on the liabilities. That way we can start to come up with a game plan.
I hear this a lot too. People say date the rate, marry the house, meaning buy now and then refinance later. How realistic is that? And what does refinancing even look like?
It is a very common phrase. I would say it's a little corny, maybe a little cliche,
Right.
but there is a lot of truth to it. And ultimately, what that comes down to is you're buying this house to be in a house. You're not buying the house to have an interest rate. So find the home that you love. Yes, the interest rates are important, but we have to realize that interest rates, just like the stock market, are cyclical. So if you're able to qualify for the home that you want, and you are in a position to feel comfortable with the rate. Maybe it's not the best rate that you were anticipating. It's not the record breaking 1.5% or 2% that we saw back in COVID, but hey, I can handle this payment. It's within my budget. I love the house. Great. If you are buying at a higher interest rate level in the market and you are in the home, when those rates come down, you have the ability to simply refinance. And what that looks like is while everybody is now going to buy their home because they were waiting for those interest rates to come down, they're now all in bidding wars on the homes they want. Or maybe those prices have gone up so much that they don't even qualify anymore. Whereas because you've already bought at a higher interest rate level and now you're just simply taking advantage of it, you get to go and then bring that rate down and that payment down even further. And there's a few different strategies behind that, redoing the 30-year term and then aggressively using those savings to pay down the principal to where, hey, this was a 30-year loan. Now I'm paying it off in 20, even though your payments stay the same. There's a lot of strategy behind it, but essentially you're getting the best of both worlds. You're in the home that you want. You
Right.
didn't overpay for it. And you got a good deal because you were in a higher interest rate market. You were able to negotiate closing costs or maybe negotiate a little bit off of the sales price. And now you're taking advantage of the flip side of that. Hey, I've already got the home, I've got the equity, I've got the price set I want it at. Now I get to leverage the fact that I have all this already and now start to benefit from lower interest rates. That's really a big driving factor behind the phrase marry the house, date the rate.
I know for my
Yep.
husband and I, being military, having to move, it ended up working out well for us. We were able to sell every house, use the equity we got from the house we sold to
To
truthfully
tier
upgrade. And so we were still maintaining a good mortgage overall cost, but we were able to increase the size or quality of the house every time.
because as you continue to build equity in the home that you're living in, sell it, you can then take that equity that you've built up over the years, plus whatever you've been saving or have set aside for a down payment that you've just naturally been doing, and combine those. Maybe I started off at a 5% down payment, but when I'm going to buy my second house, maybe I'm putting 10% down for maybe even
Exactly.
more. A lot of people, they'll never fully pay off the house, but they're using the equity that they build through not only their regular monthly payments, but through appreciation as well to leverage and either upsize or downsize. It depends because you might be going to a smaller house, but in a higher cost of living area. So there's a lot of different nuance behind that. It is buying and selling real estate. A good way to describe it is each transaction or each house is a stepping stone. Either you're going up in size or up in price, or hey, I'm in a season in my life where I don't need this much space anymore.